Welcome, everyone. Thanks for joining us today. Happy Halloween to all. We have a fabulous webcast for you. So as we get started, I want to say that we certainly welcome any comments any of you may have on today's presentation. And we are also interested in hearing from you about any suggestions or specific topics that you would like us to consider for future webcasts. For your reference, our contact information is provided at the end of this presentation. It is worth noting that the source of the data presented today is from the AFS Pricing Service. This database is the industry source of pricing trends for commercial lending and contains over $1 trillion in commitments, with approximately 80,000 new and renewed loans being added to our database each quarter. In addition, the AFS pricing database is also used to prepare our monthly pricing trends newsletter. If anyone is interested in learning more about our pricing service, or if you are interested in receiving our monthly newsletter, you can reach out to us. Again, our contact information is provided at the end of this presentation. As a baseline for our analysis, we highlighted the key findings in 3Q19 here on slide 4. One sec, there we go. Starting with balance growth, the pace of total loan growth cooled considerably in 2Q, and that pace continued to slow in 3Q. There is more than one possible explanation for the recent slowdown in loan growth. Trade tensions and the threat of escalating tariffs continue to impact business borrowing as of late, and we saw the manufacturing sector slow in the third quarter. Aggregate new and renewed year-to-date volume through September was higher than the same period a year ago. Mirroring declines in broader index and reference rates, spread pricing for new and renewed loans was down from the prior period, and fee levels increased month over month for new bilateral loans. However, fee levels for bilateral renewals were down. For our special topic today, Jeremy Charlson will look at the slowdown in lending in the manufacturing sector and shed light on the question, is manufacturing heading towards a recession? On slide 5, we look at the current environment banks are operating in today. While the economy continued to expand in the third quarter, it is giving off some mixed signals. Real GDP increased in 3Q at an annualized rate of 1.9%, down slightly from the prior quarter, but above the average prediction of many economists. Better than expected consumer spending, coupled with an increase in government expenditures, offset a decline in business spending and investment. In September, the national unemployment rate was at the lowest level seen since 1969. The current economic expansion is the longest in history, leading some to speculate that a recession is on the horizon. Ominously, the yield curve remained inverted in September. There are different views on how seriously we should take this, but the facts are, on average, 12 months after the yield curve inverts, we have a recession. This inversion has also depressed rates on long-term commercial loans, causing banks to lower their profit forecast for 2019 and 2020. Spreads remained flat in 3Q as competition for loan volume remained intense. When viewed over a longer time frame, spreads on commercial loans have not kept pace with the changes in the broader policy and reference rates. On slide 6, we get a more precise illustration of the spread compression taking place in the market. Here we focus on bilateral loans less than $5 million in size. Starting on the left, weighted average interest rates for LIBOR and prime-based loans fell in 2Q and again in 3Q. This was expected as declines in both LIBOR and prime have mirrored the Fed's 2 rate cuts through September. More of a concern is the spread trend. As illustrated by the chart on the right, the average spread on LIBOR loans fell 7 basis points in 3Q, while prime spreads were unchanged. Year over year, the average spread on LIBOR loans fell 17 basis points, while prime spreads are down 16 basis points. Spread compression, along with an inverted yield curve and the prospect for a lower for longer interest rate environment, means that bank net interest margins are under pressure and probably will remain so for the near future. From a profitability standpoint, two of the most important drivers of bank margins for commercial loans are the risk curve and the term curve. On slide 7, the chart on the left illustrates the relationship between weighted average interest rates and risk ratings. For this chart, we mapped each bank's internal obligor risk rating schema to the RMA 10-point scale in order to present a standardized look at loan pricing. As you would expect, pricing increases along with credit risk. Rates were up year over year for loans risk rated 2. Beyond this change, the contour of the risk curve was a little changed in 3Q19 when compared to the same quarter a year ago. The takeaway is that banks are not materially loosening standards when it comes to pricing for credit risk. It's a different story for the chart on the right. Last year, the term curve sloped upward with longer term lengths displaying much higher rates than shorter terms. Compared to a year ago, rates in 3Q19 were much lower for loans with term lengths beyond 10 years. The term curve appears much flatter. The recent inversion in the Treasury yield curve is contributing to this dynamic, resulting in longer duration loans not offering the same premium they once did. With balance growth having slowed in the third quarter, we thought it would be interesting to examine this trend within a historical context. The chart on slide 8 examines year-over-year C&I loan growth each month relative to the long-term historical average. Over the last 20 years or so, annual loan growth has averaged about 4.8%. When the blue line trends above the horizontal axis, that means loan growth in the given month outpaced the historical average. A few noteworthy observations. Year over year in September, total C&I loan balances increased 6.2%, which is the slowest pace of any month since September of last year, but still above the long-term historical average. So while total loan growth is decelerating, there's still enough business loan demand out there to keep the trend above the historical average. There are a number of different financial, economic, and regulatory events that have contributed to this growth pattern. For example, in 2017, we saw C&I loan growth fall beneath the historical average. Around this time, many companies were flush with cash from tax cuts, which translated into weaker loan demand. More recently, the attitude of many commercial borrowers has turned more cautious amid signs that economic conditions could worsen in 2020. Moving to slide 9, the dominant theme this quarter is margin pressure. Just yesterday, the Federal Reserve lowered the target for its benchmark rate by a quarter point, marking the third rate cut in 2019. Commercial banks are bracing for another lower for longer interest rate environment, and several regional banks have already lowered their profit forecast for next year. According to a recent American Banker article, banks will not be able to adjust deposit pricing fast enough to compensate for lower rates on their floating loans. From an earnings perspective, many financial analysts expect Q3 to be the worst for banks in this interest rate cycle. The upside to lower interest rates is that they may spur additional borrowing. Yet while consumer spending remained robust in the third quarter, a slowdown in the manufacturing sector sapped business investment. Commercial loan growth is not especially robust right now, which could tempt some lenders to loosen terms in order to generate more demand. One thing is for certain. Given these market realities, Pinpointing the areas where loan growth and pricing are still robust is more important than ever. Many of the upcoming slides today will illustrate where these areas of opportunities exist. So let's see how these market dynamics played out in 3Q19. Starting with the top left chart on slide 10, we can see that the pace of total balance growth continued to slow in the third quarter. More specifically, the September's total balance growth was the slowest since 2017. Trends in new renewed volume provide one explanation for September's sluggish balance growth. As illustrated by the top right chart, both new and renewed volume decreased in September from the prior month. Moving to the bottom left chart, we see that spreads on new and renewed loans declined month over month. When compared to last September, spread pricing for both new and renewed loans was up. And finally, we can see that as of September, total annualized fees were very similar to the same period a year ago. On slide 11, we take a closer look at balance growth trends. An interesting component of the loan growth story this quarter is the convergence of bilateral loans and participations. Starting with the top chart, the pace of bilateral loan growth, the blue line, slowed in 3Q19, but remained positive, up 0.36%. A drop in participation balances once again tempered the increase in bilateral balances. Participation balances in 3Q were down 0.31%. The decrease spanned multiple industries, and there were significant decreases in California, Georgia, Ohio, Maryland, and New York. At the bottom of this slide, we dig deeper into the trends and examine variations in year-to-date balance growth across various loan size segments. The bottom left chart focused on bilateral loans. This picture is one that we've seen many times before. Larger loans, those over $5 million in size, are growing, while lending to smaller end borrowers is down. As we noted in our last webcast, part of this divergence is due to increased competition from non-bank and fintech lenders, which continue to gain market share in the small business and business banking space. For participations on the right, balances were down for the two bookend loan size segments, less than $1 million and greater than or equal to $25 million. So how can banks leverage this information to gain a competitive advantage? In terms of improving bank performance, there are two types of critical success factors. The first group relates to internal, operational, and policy considerations. Turnaround times, approval times, robust product offerings, and holding RMs accountable for pricing and fee performance are the types of things banks can focus on internally. The other perspective banks can take is to look externally at trends in the marketplace. This is where benchmarking data from the AFS Pricing Service can help support a bank's growth strategy. The banks who best incorporate market data into their strategic view generally focus on the three pillars shown here. The first pillar focuses on growth. Each month we look to see which regions are leading the growth in new originations and how loan growth varies by line of business, industry sector, etc. In an environment where net interest margins are under pressure, it is critical for banks to optimize their commercial loan portfolios. Market data can reveal the industry sectors that consistently outperform in terms of risk and return, allowing banks to focus new lending around these high opportunity areas. Finally, while market data can shed light into the best industries and best regions, it's just as important to know which areas of the market are at a risk of overheating. For example, in a previous webcast, we noted that pricing was falling and risk was rising in Tampa, Florida, an indication of intensifying competition in that particular market. With these themes as a backdrop, we move to the next slide, where we focus on specific geographic and industry drivers of balance growth. We start with a look at the state profile. You can think of this as the regional winners and losers. The top 5 states and bottom 5 states are reported. These charts are based on the year-to-date change in outstanding dollars to determine the top 5 and bottom 5 states, and then presented ranked by the percentage change. One quick footnote, all of the geographic data presented today is based on the location of the borrower, not necessarily the location of the bank booking the loan. The chart at the top of slide 13 represents a state view for all loan types. Texas reported the largest growth in total balances during the first 9 months of the year, up 7.4%. Higher balances in 2 subsectors contributed to this growth: oil and gas extraction and telecommunications. We also see Florida up 3.9%. The accommodation and food services sector, specifically hotels, restaurants, and bars, and the transportation and warehousing sector focused on water and air transportation activities, were responsible for the higher balances in Florida. In the bottom left chart, there is a breakout for bilateral loans. Texas and California saw balances more than double the national average. The bilateral balance growth for California of 6.7% was concentrated in finances, funds, trusts, and other financial vehicles. And in other services sector, more specifically, the private household subsector, which includes services involving maids, nannies, caretakers, and gardeners. The balance growth for Texas at 7.3% was concentrated in the computer and electronic product manufacturing subsector and in telecommunications. For participations in the bottom right chart, we see Texas as the #1 state with an increase of 7.5%. And again, the oil and gas extraction subsector had the highest balances. Pennsylvania is ranked second at 5%, with large increases in 2 manufacturing subsectors, chemical manufacturing and transportation equipment manufacturing. There were also significant increases within retail trades, health, and personal care stores. On the next 2 slides, we look not only at the top 5 and bottom 5 states, but the entire country. On slide 14, we present a heat map for the balance growth across the country. The colors on the map indicate the level of dollar balance growth experienced by a particular state, with dark green indicating the highest level of growth and red representing a decline. The map on this slide focuses on bilateral loans, and we can see that balances were up across most states at the end of September. As mentioned earlier, balances are higher in California, Florida, and Texas. North Carolina is also a top 5 state with higher balances in finance and insurances, securities, commodity contracts, and other financial instruments subsector, and in the accommodation and food services sector. As we've seen over the past 2 quarters, balances are down in several states in the Ohio River Valley, in states like Ohio, Indiana, and Kentucky. This year, balances in Ohio are down significantly in food manufacturing, and Indiana balances are down in retail trades, motor vehicle, and parts subsector. Balances are also down across several north-central states like Minnesota, Wisconsin, Iowa, Nebraska, and South Dakota. Like Ohio, Minnesota's balances are also down in food manufacturing, as well as in wholesale trades, merchant wholesaler of non-durable goods. The map presented on slide 15 changes our focus to the year-to-date balance growth for participations. Participation balances were up across most states. However, all that red you are seeing adds up to 24 states with negative growth this year. Texas is the only state to appear in the top 5 for both bilateral loans and for participations. And Ohio, which we just saw is the number one bottom 5 state for bilateral loans, is also a bottom 5 state for participations. The professional, scientific, and technical services sector and the hospital subsector have contributed to Ohio's lower participation balances this year. As the last few slides have demonstrated, there are clearly a handful of geographic markets that have generated balance growth well above the national average. On slide 16, we present a more concise picture of this dynamic. Here, we identify and aggregate the top 10 CBSAs based on their contribution to total U.S. real GDP. The assumption here is that a region's level of economic activity is related to its potential for future loan growth. The top 10 CBSAs are illustrated in aggregate by the dark blue bars, whereas the lighter shaded bars represent all other geographic markets. Since March of 2016, the pace of total balance growth for the top 10 CBSAs has accelerated during every quarter, far outpacing the growth rate for all other geographic regions. You can see on the far right that while total loan balances for the top 10 CBSAs continues to grow, climbing higher by 0.7% in the third quarter to 18.3%, the remaining markets have been well below this pace. We do see that balances in the other regions were increasing in Q1 and Q2, but fell below 4% as of 3Q, much lower than the 18% rate for the top 10 CBSAs. The implication here is that as business borrowing picks up, the top 10 CBSAs have continued to experience significant increases in total loan balances, and the AFS pricing service has the data to help you find where opportunities exist in today's improving markets. Using the AFS pricing service, you can examine trends within states. Our pricing service is configured to drill down beyond the state level and view trends for specific core-based statistical areas, or CBSAs. For example, we just saw Texas in the top 5 states for both bilateral and participation loan growth. On slide 17, we can see that the year-to-date growth rate of 7.3% for bilateral loans in Texas exceeded the national average of 2.8%. And Austin and Dallas, El Paso and Houston contributed to that higher than average growth rate. However, San Antonio actually lost ground during the first 9 months of 2019, down 7.5%. This geographic precision allows us to distinguish the winners and losers very quickly and is the type of data you can leverage to be very competitive in your own markets. As we move to slide 18, we continue our focus on balance growth and highlight the best and worst performing industries. The management sector is ranked highest for total balance growth for the first 9 months of the year, with the largest growth seen in Raleigh, North Carolina, and Palm Beach, Florida. The mining, oil, and gas sector is ranked second highest for total balance growth for the first 9 months of the year, with the largest growth seen in Texas, specifically in Midland, Dallas, and Houston. Higher balances were also seen in Pittsburgh, Pennsylvania, and Denver, Colorado. Moving down to the bottom 2 charts, we can see that 2 sectors, transportation, air, water, truck, and finance and insurance, rank among the top 5 fastest growing industries for both bilateral loans and participations. Both sectors are significantly higher than the all-industry average. The chart on the left shows bilateral loan growth, and information is the top industry, especially in cities like Los Angeles, Dallas, and St. Louis. Transportation, air, water, truck is ranked second, with balances advancing in Orlando and Miami, Florida, Dallas and Houston, Texas, and Los Angeles, California. Honing in on participation growth, we again see the transportation, air, water, truck sector. Here we saw significant growth in Oklahoma City, Tulsa, Oklahoma, and Miami, Florida. The arts, entertainment, and recreation sector is ranked highest with growth seen in Columbia and Branson, Missouri, Los Angeles, California, and Chicago, Illinois. On the next two slides, we again look across the entire country and present the industry with the largest year-to-date growth in each state. On slide 19, we focus on bilateral loans. Along the East Coast, not surprising, we see a heavy concentration in the finance sector, with dark blue shading for states like New York, Massachusetts, New Jersey, Delaware, North Carolina, and Florida. The map presented on slide 20 changes our focus to the balance growth for participations. As with the preceding slide, the industry with the largest year-to-date growth in each state is presented. We can see that several states are shaded light blue, which means that the manufacturing sector is the major industry. And as you might expect, states like Michigan, Ohio, and Pennsylvania are highlighted. A few slides ago, we saw the granularity that the AFS pricing service provides users when looking at trends across the country, with insights down to the CBSA level. Our pricing service also lets you examine trends within industries. Industry trends can be analyzed all the way down to a 6-digit NAICS code. On slide 21, we see that within the manufacturing sector, focused on machinery and electronic products, the computer and electronic product manufacturing subsector had a negative impact on loan growth during the first 9 months of the year. Drilling further down to the 6-digit NAICS level, we see that the semiconductor and related device manufacturing subsector, down 24%, is responsible for the lower balances. While balances tied to the electronic computer manufacturing subsector and the search, detection, navigation subsector increased 19% and 40% respectively. Having this granularity is what the AFS pricing service provides, and something for you to consider when you need very detailed data to support your own pricing decisions. In addition to examining trends in total balances, the AFS pricing service enables users to analyze trends for new and renewed loans in order to gain valuable insights into the impact of the most recent lending activity. On slide 22, we begin with a look at new and renewed bilateral loans. Starting on the left, we can see that September's new and renewed loan volume is higher than last September, with higher new volumes in the finance and insurance sector and the utility sector. Renewal volume was also higher in the manufacturing sector, focused on machinery and electronic products and transportation equipment, as well as in the manufacturing of food, beverage, tobacco, and apparel. Moving to the chart on the right, we focus on the pricing of the most recent lending activity. The LIBOR equivalent spreads as of September for new loans are slightly higher than September of last year, up 4 basis points, while spreads on renewed loans were up 15 basis points. When compared to the previous month, the weighted average LIBOR equivalent spread for new loans went down 13 basis points to 196. For renewals, the average spread of 209 basis points is down 4 basis points from the previous month. To help demonstrate the competitive landscape that persists in commercial lending, slide 23 looks at the drivers of commercial loan pricing. Two of the most important determinants we see are risk rating and deal size. The charts here show the long-term trends in pricing for bilateral loans by focusing on LIBOR equivalent spreads. The chart on the left looks at spreads across risk. The dotted black line depicts the market average, and we can see the steady decline in spread pricing over the last several years. We know that over this time, many banks have adjusted their loan mix to focus on better rated credits. However, the overall spread compression is reflected across all risk segments, not just the best rated loans. In fact, the low-pass segment displayed the largest average quarter-by-quarter compression seen over this time frame. A similar picture is presented by loan size on the right. From a loan size perspective, spread compression was evident across all segments. The smallest loans, the red line representing deals under $1 million, have experienced a rebound in spread pricing as of late. But when viewed over the long term, this segment, as well as the other segments, have seen spreads fall significantly over this time period. Next, we will quickly look at the volume and pricing trends for participations. On slide 24, the chart on the left shows that total new and renewed volumes for September are down when compared to last month, and we saw that manufacturing balance were much lower this month. Compared to September of last year, new volume is up and renewed volume is down. The finance and insurance sector helped drive up new volume, while the manufacturing of machinery, electronic products, and transportation equipment drove down renewal balances. Looking at the chart on the right, a direct relationship is seen for new loans and renewals. As we compare to the prior month, loan volumes down. The weighted average LIBOR equivalent spread for new loans of 197 basis points is down 13 basis points, and the average spread for renewals fell 6 basis points to 210 basis points. When compared to the same month last year, the weighted average LIBOR equivalent spreads for new loans is up 26 basis points, while the average spread for renewals rose 17 basis points. Next, we look at the final layer of our market review. Slide 25 focuses on commercial loan fee performance. Fee revenue is a vital part of overall bank profitability, and this slide provides insight on A, how frequently upfront fees are assessed, shown here as the fee incidence, and B, the total amount of fees assessed, or the fee level. The chart at the top left of this slide shows that on a year-over-year basis, the fee incidence rate is down for new bilateral loans and was up slightly for renewals. On the top right, we can see that the fee level for new loans edged higher in September, rising above the level seen a year ago, while the level for renewals was below the level reported a year earlier. As we saw with loan volume and spread pricing, the AFS pricing service enables users to examine regional drivers of fee performance. Consistent with the prior year, the South was the highest region in terms of upfront fee incidence, as shown on the bottom left chart. Florida, Georgia, and South Carolina contributed with higher than average incidence rates. The bottom right chart shows that the South and the West regions displayed the highest upfront fee levels. Again, in the South region, Florida, Georgia, and South Carolina also reported high fee levels. And now we will transition into our special topic for today. Jeremy Charlson will provide an analysis of economic and commercial lending trends in the manufacturing sector. Jeremy?
All right, thank you, Don. So one of the most important and diverse industries for C&I lending is, of course, manufacturing. For many banks that we work with, manufacturing is actually the largest concentration of C&I balances, exceeding even sectors like finance and insurance and wholesale trade. It's also an industry that's flashing several signs of caution. Last quarter in our webinar series, we explored the ongoing U.S.-China trade war and what impact it was having on commercial banking. The tariffs are definitely hurting profits of many manufacturing companies, especially those focused on things like automobiles and machinery, or companies that derive the bulk of their revenue from exports. Regulators and politicians have both recognized some of these warning signs. In fact, it was weakness in the Industrial Production Index that was cited by Fed J. Powell as primary reasons for the interest rate cuts this year. I think, again, it was mentioned in the Fed's statement yesterday as well. And on the campaign trail, Senator Elizabeth Warren had asserted that the U.S. is in the midst of a quote-unquote manufacturing recession. By one measure, that's technically true, while there are some other indicators that show that manufacturing is still growing, but at an increasingly slower pace. So what we'd like to do in today's special topic is drill a little bit deeper into the lending trends of the manufacturing industry. We'll first determine if the weakness in the sector is translated into any material impact or change in the risk and return profile of manufacturing borrowers. And as an added bonus, we'll also incorporate data from our credit risk database, the Risk Analysis Service, to see if things like past dues and non-accruals are beginning to rise in the sector. So to level set, I included a few snippets from a recent American Banker article describing the precarious state of the manufacturing industry. As I mentioned, the trade war is weighing very heavily on the sector. The article here cites revenue declines, reduced liquidity, and increased leverage as among the reasons for credit risk managers to be wary of manufacturing's near-term outlook. Much has been written about the ag sector this year, with farmers in the Midwest bearing the brunt of a lot of the tariffs, especially soybean farmers. Upstream in the ag sector, manufacturers of farm equipment have also reported pinched profits as of late. Still, if and when manufacturing borrowers begin to experience debt service challenges, it will likely sector, and especially that this industry was really the predominant driver of a lot of the growth and pricing trends that we're seeing in the marketplace today. And the pictures here, these are the four most reliable indicators of manufacturing health. So earlier, what happened with the rate cuts, one of the reasons cited by Fed Jay Powell was that weakness in the manufacturing sector was a key reason behind why they lowered interest rates. And actually, Senator Elizabeth Warren on the campaign trail had cited that manufacturing was currently in a recession, and she was using that as part of her campaign message. And what we see here on this slide, if you look in the top left corner, the industrial production index actually had declined for 2 quarters this year. So by that measure, technically manufacturing was in a recession earlier this summer. Now it did rebound in 3Q, but that drop in 1Q and 2Q is definitely a troubling sign for the overall industry. If you look on the top right there for capacity utilization, that is a measure of the potential output which could be produced if all resources are utilized. And just like industrial production index, that particular measure had been declining for the last several quarters. So again, not a good sign for the overall health of the manufacturing industry. Yet there's some other key performance indicators in manufacturing that point to a continued expansion. So take employment on the bottom left. Employment in the manufacturing industry has increased every quarter over the last 2 years. So by that measure, manufacturing still showing somewhat of an expansion in the most recent couple of quarters. And I think we're hearing that the audio is still fading in and out here. So I'll do my best to speak up a little bit louder. Renee, can you back to the prior slide, please? Yes, please. Yeah, so hopefully now everyone can still hear me. And just the final metric we wanted to plot on this slide was the Purchasers Managers Index. It's really a pretty reliable measure of whether or not the sector is contracting or not. And in 3Q19, that index dipped below 50, which would mean that many manufacturers are falling inventories, falling production. So really some mixed signals in the sector that are going to have major ramifications for the growth and credit trends in this industry. Sure. Okay, you can move to the next slide, please. All right, and apologies again, folks. I think we were still having some audio issues, so I'm now speaking through a different headset, which hopefully should help clear that up. And actually, Renee, in the interest of time, could you go to the next slide, please? So this is a breakdown of the manufacturing industry in terms of its subsectors. And what we see is that there's many different commodities, consumer goods, and supply chains represented by the manufacturing industry. At the end of the third quarter, computer and electronic manufacturing was the largest subsector in the broad industry. That's the dark blue slice on this pie. This is the same subsector that is perhaps the one most tied to the fate of the trade war. According to Evercore, China accounted for 35% of global semiconductor sales last year, with Chinese company Huawei alone purchasing $11 billion worth of computer components from American manufacturers. A lot of the subsectors here are preceded by the integer 33, which really represents manufacturing of metals, machinery, and electrical goods. So again, a lot of those subsectors are going to have major consequences in terms of the trade war. A lot of the things like washing machines and other steel and aluminum products, those goods fall within those particular subsectors. So given the negative impact of the trade war on manufacturing, what's been the recent loan growth trend in the sector? Manufacturing here is illustrated in red, and the average for all industries is shown by the dotted black line. And what we've been seeing is that for most quarters this year, growth in the manufacturing industry has been slowing pretty considerably. It really peaked around January of this year before falling substantially over the last few months, which really mirrors trends in things like the industrial production index and capacity utilization. In the most recent period, year-over-year growth in manufacturing was 2.8%, which was below the pace realized by all C&I industries. And here we show just how relevant things like the industrial production index and capacity utilization are to growth in the sector. The red line is the same series from the preceding slide. It's the year-over-year growth in manufacturing, whereas the dotted black line is the industrial production index. And what you can see here is that there's a very strong, positive, but not perfectly linear relationship between the two variables. So when industrial production falls, loan growth tends to fall few quarters afterwards. So it's a very strong determinant of trends in this particular industry. Now, earlier this year, we actually did have a quote unquote manufacturing recession where the industrial production index fell for 2 consecutive quarters. If that repeats again in 2020, you can expect manufacturing loan growth again to fall given the strong correlation exhibited here on this slide. Now, to be sure, loan growth trends can and do vary by subsector. Here we've plotted year-over-year loan growth rates for manufacturing, broken out by its main subcomponents. And what we saw over the last year is that transportation, machinery, and chemical manufacturing, which are the green bars here, all enjoyed pretty solid loan growth. It was actually the sectors of computer manufacturing, metals, and food that were responsible for the recent slowing in manufacturing. Again, computer manufacturing is really probably the subsector most tied to the fate of the trade war, and the one that we're really keeping a close eye on as of late. Now, given the many risk factors in the manufacturing sector, you might think that lenders on average would demand higher returns on these loans. However, as the data shows, that was not really the case. On the left-hand chart, we plot weighted average interest rates for manufacturing versus all C&I industries, manufacturing being the red series here. And what we saw for nearly every month over the last 2 years was that the weighted average interest rate for manufacturing was actually lower than the C&I average. Now, it's possible that for manufacturing loans, banks are offsetting lower rates with higher fees. But one thing that we reported in our latest C&I Pricing Trends newsletter was that fee incidence and fee levels for manufacturing really aren't that strong. So the all-in rate for manufacturing is actually much lower than what we see at the all industries level. We have a similar perspective on the right-hand slide, where this time we look at trends in weighted average risk rating. For manufacturing, the weighted average risk rating was particularly volatile during the beginning of the series. Not sure really what to make of that. Once again, in the latest month, in September, we saw a spike in the weighted average risk rating for manufacturing. That could reflect, again, the deterioration in things like capacity utilization and the PMI. But viewed together, these charts show an important characteristic of the manufacturing industry. Pricing is lower and risk is higher compared with C&I averages. When looking at industry returns, one critical component is the pricing index distribution. And what we have here, if you look on the far left, is we break out manufacturing and then the average for all industries by fixed LIBOR and prime-based loans. For both segments, LIBOR is the predominant index. It represents about 3/4 of the total new and renewed volume in manufacturing. Compared to the C&I average, we see prime lending less frequently in manufacturing with comparatively more fixed deals. The middle chart here looks at spreads on LIBOR-based loans, both for manufacturing and for C&I industries, the all C&I industries. What we saw was that spreads on manufacturing loans tied to LIBOR widened year over year, as contrasted with a decline in LIBOR spread for the broad market. However, the average spread for LIBOR manufacturing loans was slightly beneath that seen at the all industries level. So on a spread basis, manufacturing, just like we saw with weighted average interest rates, is trailing the all industries average. It's really not looking too good from that perspective. On the far right, looking at spreads on prime loans, manufacturing loans tied to prime, while not very prevalent in terms of volume, did have much higher spreads than we see on average. So at least for the prime-based deals in the sector, the returns are pretty solid. A more concise picture of industry risk and return is presented here on this slide. Each bubble is one of the major NAICS industry groupings like healthcare, retail, trade, and so on. And what we do for each sector is we plot the weighted average risk rating along the x-axis versus the weighted average interest rate down the y. The worst quadrant to be in this perspective is the bottom right, where risk is higher and pricing is lower. And most notably, manufacturing falls in this particular unfavorable quadrant. It's also worth noting that the related industries of retail trade and wholesale trade also fall into the same unfavorable quadrant. Now, this is mainly speculation, but it's certainly possible that the adverse effects of the tariffs are eroding the risk and return profiles of these particular industries. Now, while the weighted average risk rating, which is really a default projection for the manufacturing sector, has deteriorated as of late, non-performing loan levels remain relatively low for the overall sector. What we did on this slide, we actually pulled in data from our risk analysis service, which is our credit risk database. And what we've done is we've plotted trends in non-accruals and past dues for manufacturing versus the C&I average. So we'll look at actual credit performance as opposed to risk ratings. So if you start on the left-hand chart, we can see that the percentage of non-accruing manufacturing loans fell both quarter over quarter and year over year. Moreover, during the most recent quarter sampled, the non-accrual rate for manufacturing was lower or better than the C&I average. On the right, we can see that delinquent manufacturing loans also remain at pretty manageable levels. The delinquency rate for manufacturing in the most recent quarter was a mere 37 basis points, which was only marginally higher than that seen for the C&I average. So really, in terms of actual performance, non-accruals and delinquencies, manufacturing still on pretty solid footing. And on this slide here, we look at the non-accrual and past due trends, this time broken out by the subsectors in manufacturing. I know it's a much busier view, but I'd like to point your attention to the right-hand chart, which is the past due ratios for the manufacturing subsectors. What we saw over the last year is that delinquencies actually rose pretty significantly for some subsectors in manufacturing. So while at the total industry level, past dues are manageable, they're low, there are some segments of manufacturing that are showing signs of stress, those being the manufacturing subsectors focused on chemicals, machinery, and computers and electronics. Again, all three of those subsectors very sensitive to the ongoing trade war. A lot of the tariffs or the products where tariffs have been levied on those particular segments of the manufacturing industry. So given the size of the manufacturing sector in terms of C&I loan volume, it's a sector that has major ramifications for most commercial banks, as well as for the C&I loan market as a whole. Do the industry and credit fundamentals support the narrative that the US is currently in a manufacturing recession, as some politicians and economists believe? It's kind of hard to say. Manufacturing loan growth certainly has cooled in 2019, although some subsectors within the broader industry continue to grow at a pretty rapid pace. The more concerning aspect is that pricing is lower and risk is higher for manufacturing versus all other C&I industries. So for banks looking to manage margin or grow net interest income, manufacturing is really not a great sector at the moment. Yet despite all of these headwinds, the actual and current credit performance of manufacturing, as measured by things like non-accruals and delinquencies, is still on pretty solid footing. So for now, at least, credit conditions in the manufacturing sector remain relatively benign. So we apologize for some of the technical difficulties we had earlier on. Certainly, this was a really interesting quarter, both with some of the macro events going on and for the developments in the manufacturing sector. For those of you that weren't able to rejoin the audio, this is our contact information. We'd be more than happy to answer any questions you may have, both about the service in general or about any particular industries. We love to have those kind of conversations with our clients. So with that, we want to respect your time. We know we're at the top of the hour. We'll see if we have any questions on the line. No questions at the moment? Sure. So just a reminder, you will get a copy of this presentation and the recording deck. Again, we apologize for some of the technical difficulties we had earlier in the presentation. Any questions about our pricing service, about our newsletter, or about any industries you'd like us to focus on for future webinars, please feel free to send us a note or give us a call here. On behalf of AFS, thank you for your time, and thank you to all the banks that participate in the pricing dashboard.